Your 30s are a strange decade. One moment you feel proud because you finally earn a decent salary, and the next moment you're staring at a mortgage calculator, wondering how anyone ever figured out how to be a real adult. At the same time, your bank account is being pulled in a dozen different directions, like it's some kind of financial piñata. Kids might need college money, houses need repairs. Retirement accounts are begging for attention, and somehow you're also supposed to keep your sanity through all of it. Here's the part nobody warns you about. Everyone talks about your 20s as the decade where you're supposed to figure things out. But your 30s? That's when you realize you were supposed to have already figured them out. The financial decisions you make during this decade don't just affect the next few years, they quietly determine whether the next 30 years of your life feel calm and controlled, or stressful and reactive. My name is Quinn, and welcome back to Quinn Invests US. I help people understand money in a way that actually fits real life. And if you ever feel like your money disappears as fast as you earn it, make sure you subscribe and hit like if this helps you get your financial life back under control. Before we get into these milestones, let me be clear about something. This is not about judging where you are financially. Maybe you're already ahead on some of these. Maybe you're watching this while looking at your bank balance and wondering if you should just give up and become a professional daydreamer. Either way, these milestones are not a report card. They're a roadmap. A way to navigate what is honestly one of the most overwhelming decades of adult life. The first major money milestone you want to hit in your 30s is eliminating all consumer debt. And yes, I mean all of it. Completely gone. Zero. Nothing left. The only exception here is a mortgage if you have one. Everything else needs to disappear. Credit cards, student loans, car payments, that random personal loan you took out years ago and barely remember what it was for. All of it. I know what you're thinking. Quinn, that sounds impossible. My student loans alone could fund a small country. But here's why this matters so much during your 30s. This decade is usually your prime earning period. Your salary is likely higher than it's ever been. And for many people, it's still climbing. The worst thing you can do during your highest earning years is allow consumer debt to act like financial quicksand, pulling down every dollar you earn. Think about it this way. If you're paying $400 a month on credit cards and another $600 on a car payment, that's $1,000 every single month going toward the past. Over 1 year, that's $12,000. Over 10 years, that's $120,000. And that doesn't even include what that money could have grown into if it were invested instead. Your 30s are also when life starts getting complicated very fast. More responsibility at work, managing a household, possibly raising kids. And for many people, this is also when aging parents start needing more help. Carrying consumer debt through all of this is like juggling flaming torches while riding a unicycle. Possible? Maybe? Smart? Absolutely not. I learned this lesson personally when my dad started needing more help around the house. He's one of those stubborn guys who insists he can fix anything himself, which usually means either I end up fixing it or I pay someone else to do it properly. Not long ago, we had a plumbing issue he decided to handle with nothing but determination and a plunger. Spoiler alert, it didn't work. If I hadn't had financial flexibility at that moment, calling a plumber would have been stressful instead of simple. That brings us to the second milestone, and this one is massively underestimated: achieving an excellent credit score. And when I say excellent, I mean 800 or higher. Now, I already know some of you are rolling your eyes, thinking credit scores don't matter if you're not planning to borrow money. But here's the reality. Even if you hate debt, your credit score still determines how expensive your life is. If you ever plan to buy a home, your credit score directly affects how much that home costs you. Let's put this into perspective. Imagine buying a $400,000 home. With an excellent credit score, you might qualify for a 6.5% interest rate. Over 30 years, you'll pay roughly $511,000 in interest. Not great, but that's modern reality. Now imagine your credit score is just a bit worse. Not terrible, just not excellent. That might push your rate to 7%. That small difference means you'll pay around $558,000 in interest over the life of the loan. That's nearly $50,000 more for the exact same house. And it gets worse. According to LendingTree, a single late payment that's more than 30 days overdue can drop your credit score by as much as 180 points and stay on your credit report for up to 7 years. One missed payment can turn a great credit score into a mediocre one almost overnight. That one mistake can literally cost you tens of thousands of dollars over your lifetime. The good news is that maintaining excellent credit is not complicated. Pay every bill on time, every time. Keep your credit utilization under 30%, ideally under 10. Don't open new accounts unless you actually need them. And whatever you do, don't close old credit cards unless they have fees you can't justify. Length of credit history matters, and closing old accounts can actually hurt your score. The third milestone is creating a comprehensive financial plan for the next 30 years. I know, planning 30 years ahead sounds overwhelming, but your 30s are when multiple financial priorities collide at the same time. Without a plan, you end up playing financial whack-a-mole, reacting to whatever problem pops up next instead of moving intentionally toward your goals. I like to think of this as having a framework for your finances. You need to know how budgeting and saving support your long-term goals. You need to understand whether your retirement contributions are actually putting you on track. You need to consider tax strategies that legally help you keep more of what you earn. And if you have children or significant assets, estate planning stops being optional. For some people, this is the point where working with a financial planner makes sense. Especially if your income is variable, you have multiple assets, or your family situation is complex. A good planner doesn't tell you what to do. They help you see the entire picture and make sure all the moving parts actually work together. The fourth milestone is building a truly bulletproof emergency fund. In your 20s, the standard advice is 3 to 6 months of expenses. In your 30s, I want you to think bigger. 6 to 12 months of living expenses is far more realistic, especially if your income isn't guaranteed or you're self-employed. Why the increase? Because your 30s come with bigger, more expensive emergencies. Home repairs, medical costs for kids, car issues that are somehow always complicated and expensive, helping parents with unexpected expenses, or sometimes a good emergency like a once-in-a-lifetime investment opportunity that requires fast action. A strong emergency fund isn't just about safety, it's about options. When you know you can handle whatever life throws at you, you negotiate differently at work. You take smarter risks, you help family members when they need it, and you sleep better at night knowing one surprise expense won't destroy your entire plan. Keep this money accessible and boring. High-yield savings accounts are perfect. The goal is stability, not growth. The fifth milestone is having at least 3 times your annual income saved for retirement by age 40. According to recent data, the average 40-year-old in the US earns around $62,000. That means having roughly $186,000 saved for retirement by that age. Before you panic, here's the important context. If you reach that level by 40 and continue saving responsibly, retirement projections often show balances well over $2 million by your late 60s. That's the power of compound growth, but only if you give it enough time. This milestone isn't just about the number. It's about understanding that your retirement savings should be doing real work for you. If you're behind, don't freeze. Get serious about increasing contributions, especially when your income rises. The difference between saving 10% and 15% of your income may not feel huge now, but over 25 years it can mean the difference between financial freedom and working far longer than you want to. The sixth milestone is something I call immunity to lifestyle inflation. Your 30s are prime time for lifestyle creep. You get a raise, so you upgrade your apartment. You get a bonus, so you upgrade your car. Your income rises, and somehow your expenses rise right along with it, leaving you with the same amount of money at the end of the month as before. I know people earning 6 figures who are constantly broke. Expensive cars, high-end apartments, eating out every night, and at the same time they claim it's impossible to get ahead. The secret weapon against lifestyle inflation isn't deprivation, it's automation and awareness. Every time your income increases, automatically send at least half of that increase towards saving or investing before you have a chance to get used to spending it. That way, your future self benefits immediately, and your current lifestyle barely changes. The seventh milestone is putting basic estate planning documents in place. I know it sounds uncomfortable, especially if you're still young, but if you have children, a mortgage, or meaningful assets, this is an act of responsibility, not pessimism. Estate planning isn't about planning for death, it's about planning for the unexpected. Who takes care of your kids? Who makes decisions if you're incapacitated? What happens to your assets? Without documents, those decisions are made by courts and bureaucrats, not by you. For most people, basic online tools are enough to get started. If your situation is complex, working with an attorney makes sense, but something is infinitely better than nothing. The eighth milestone is investing in your health. And no, this isn't a fitness lecture, it's financial reality. The average American spends over $300,000 on healthcare over their lifetime. If you can reduce that by even 20% through preventive care, better nutrition, regular movement, and stress management, you've effectively saved yourself $60,000. That doesn't even include lost income from illness or missed opportunities due to low energy and poor health. Your 30s are when habits become harder to change, but also when they still have massive long-term impact. The money you spend now on taking care of yourself is nothing compared to what poor health costs later. The 9th milestone is thinking seriously about your children's education if you plan to have kids. College costs have risen faster than inflation for decades. A public 4-year university can easily cost over $40,000 per year when everything is included. Private schools can reach $70,000 per year. You don't need to fully fund college, but starting early gives compound growth time to work. Education savings plans are designed for this purpose and offer powerful tax advantages. Even small monthly contributions can grow into meaningful support over time. And finally, the 10th milestone is developing financial confidence. Not a specific dollar amount, confidence, knowing your numbers, understanding how your accounts work, trusting your system, being able to make decisions without panicking every time the market dips or an unexpected expense shows up. Financial confidence comes from preparation, not guessing, from having a plan you understand and believe in, one that adapts as your life changes and keeps you moving forward even when things feel uncertain. Your 30s are your financial prime. You earn more than you used to. You still have decades for compound growth to work, but you also carry more responsibility than ever. The choices you make now decide whether your 40s, 50s, and 60s feel secure or stressful. Your 30s don't have to be a financial disaster movie where you're the main character in your own tragedy. These milestones are here to guide you, not overwhelm you. Pick one or two that matter most right now. Start there. Small, consistent actions compound, just like your investments.